Good afternoon on the East Coast and good morning on the West Coast, and hello to everyone in between. Thank you for joining us to discuss UGE International second quarter results for fiscal 2020. On the call today, we have UGE CEO Nick Blitterswyk and Paul Kania, UGE CFO. During the call, all participants are in a listen-only mode. Following the presentation, we will conduct a question and answer session. You can submit your questions to the Q&A tab on the top left-hand side in the web portal at any time, and management will answer them following their prepared remarks. Before management discusses the results, I'd like to remind everyone that certain statements in this call may be forward-looking in nature. These include statements involving known and unknown risks, uncertainties, and other factors that could cause actual results to differ materially from those expressed or implied in our forward-looking statements, including our assessment of the potential impact of COVID-19. For caveats about forward-looking statements and risk factors, please see our MD&A for the year ended December 31st, 2019, which can be found on our company profiles at sedar.com. I will now turn the call over to UGE CEO Nick Blitterswyk. Nick?
Thanks, Marcel. First off, I would like to welcome everyone to the call and thank you for joining. My name is Nick Blitterswyk, CEO of UGE International. For this webinar, first, I'm going to run through the agenda and let you know where you can find additional information. Next, Paul Kania, our CFO, will provide a high-level review of our income statement and run through some of the key pieces of our financials and how they relate to the business. I will then provide an update on our backlog before each of us provide an update on two subsequent events that occurred after the close of the second quarter. We will then take questions and wrap up the webinar. As a reminder, you can submit a question through the portal by submitting a question on the left-hand side of your screen. As always, our goal is to be mindful of your time and keep this webinar concise and to the point. We will be speaking relatively high level and focusing on the areas that we feel are most important to understanding our results in the business. We also want to remind our listeners that we report in US dollars, so the results in this webinar are represented in US dollars as well, unless addressed otherwise. Although we will keep things fairly high level on this call, our website address is listed here as well, where you can download our full financials. So with that, I'll turn over to Paul to start by discussing our income statement.
Thanks, Nick. As Nick mentioned, I will start by highlighting a few key areas of our income statement and performance during the first half of 2020. On this slide, we show the full income statement as seen in our financials. With respect to revenue, while revenue declined year over year, it actually grew quite substantially when looking at our ongoing business operations. As we have discussed in our prior calls, we wound down our former EPC service business in late 2019. When only looking at the US and Philippines business, along with consulting revenue has grown 140% in the first half of 2020 compared with the same period from 2019. That despite COVID-19, which all but halted construction in March, April, and May. Our gross margins have continued to perform well. The second quarter proved to be the highest in the company's history, which was primarily attributable to a one-time event as we recognized revenue which had been previously held back for conservatism. That said, we continue to see much stronger operating margins after pivoting the business away from EPC services and focusing on our self-developed projects. Of course, Q2 was right in the midst of COVID-19 pandemic. During this time, we took temporary measures to limit expenses, which saw SG&A expenses fall 29% during the second quarter. We currently expect expenses to gradually return to pre-COVID levels through the remainder of the year. We also want to thank our great team for working together to get through this unprecedented time. My last comment on the income statement, while we are not yet at our goal of being consistently profitable, our adjusted EBITDA narrowed to negative $93,000 due to higher margins and lower expenses. We continue to believe that we have the right ingredients in place to be consistently profitable in the near future. And with that, I'll turn the call over to Nick to go through our backlog.
Thanks, Paul. Our growing backlog has been one of the main highlights this year, and that growth continued in Q2. By June 30th, our backlog had grown to over 83 million, compared with 72 million at the end of Q1. That included 52 megawatts of projects, up from 43 megawatts at the end of Q1. One small note to make is that we updated two of the fields to add clarity. We have renamed Year Zero revenue as upfront revenue, which is the revenue we earn as a project is deployed, and we have replaced Year One revenue with the average annual revenue that the project will generate over its lifetime. This is the recurring revenue component. To highlight some of the key results, our backlog now includes 61 projects, 42 of which are ones that we are developing with the intention to self-finance. That is 6 more than we had at the end of Q1. In total, the backlog is over 52 megawatts of projects, representing over 83 million in backlog value. The upfront revenue component is approximately 15 million, and the annual recurring revenue component, once projects are operational, is expected to be 8.6 million. We also show here the backlog aggregated by stage, starting with stage 3.1, which represents our newest client commitments. This bucket is currently largest due to the growth we've experienced this year, which means many of the projects are at the top of the backlog funnel. On the other hand, stages 4 and 5 are currently in deployment, and stages 3.3 are projects in the final stages before deployment begins. Along with growth in the overall backlog, we will be tracking the maturation of our backlog as we aim to deploy all of our backlog within about 24 months. I will also mention that 2 of the stage 5 projects have reached commercial operation since the close of the quarter. In the last 2 quarters, we have started to share significantly more information on our backlog, but we plan to continue to share more as we go forward. We believe there is significant value in our backlog, as well as the broader pipeline that precedes it, and look forward to shining more light on that as it continues to grow and mature. At its core, our backlog represents significant long-term recurring revenue with strong margins in a rapidly growing industry. I will now turn the call back over to Paul to discuss the recent exercise of warrants.
Thanks, Nick. Subsequent to the close of the quarter, a warrant provision was accelerated on the 33-cent warrants from our February private placement. The accelerated expiration date was August 17, 2020, and 100% of the warrants were exercised prior to this date, resulting in approximately 500,000 Canadian dollars in proceeds. This warrant exercise has buffered our balance sheet since quarter end, as we continue to make progress in strengthening our balance sheet. One of the uses of the capital has been to settle debt outstanding, as Nick will now discuss.
Thanks, Paul. The second subsequent event we wanted to highlight the settlement of debt outstanding for our UGE Canada RE business unit, which represents the EPC business that we have wound down. On the June 30 balance sheet, there was approximately 1.23 million of debt outstanding for this business, as shown here on this slide. We have since successfully negotiated a settlement in full for payment of approximately $137,000, which will be reflected on our Q3 balance sheet. On a related note, our balance sheet also does not yet reflect settlement of other liabilities of that business. We expect our proposal to creditors to be accepted by the courts in the coming months, and we'll provide an update on that in due course. Paul, back to you.
Thanks, Nick. With that, we will wrap up the prepared remarks by pointing to where you can find more information. As mentioned earlier, our website is regularly updated and contains all of our financial filings and other updates. You can also visit Sophic Capital's website for additional information. You can also follow us on Twitter to get links to announcements and other media. Thanks again for tuning in today. Marcel, back to you.
Thank you, Paul. We've collected the questions investors have submitted via email since issuing the financial results this morning. We've also collected the questions submitted through the web portal's Q&A tab during management's prepared remarks. We invite listeners to continue submitting questions to the Q&A tab at the top left-hand side of the web portal. So let's move on to our first question. Question number 1. From the time you engage a prospect, how long does it take before UGE generates revenue?
Yeah, I'll take that. So from the time we engage a prospect to the time that we count that as a commitment, that can vary quite significantly, although it is one of the areas of the business that we've seen shrinkage as our business grows and as the model that we have in the market becomes more well known. But it definitely varies. There are situations where we might meet a client and sign a commitment within about a month, and there's other cases where it could be a year. So that's the initial commitment stage. And then maybe I'll just elaborate a little bit further. Once we have a commitment, and we call that project stage 3.1, our main focus there is to develop that project, which means go through the different steps to get that into construction. So in our business, that is one of the areas that we really set ourselves apart, is working with the utility, working with engineering, which we have in-house, working with our financing partners on the projects in order to bundle a project that's going to have optimal value. And that process itself is typically, I would say, about 4 to 6 months. until you have a project ready to construct. So, and of course, it varies based on the size and complexity of a project as well. And so, with the backlog that we showed earlier, one of our real focuses right now, of course, is getting more and more of our projects into stage 4, which is where deployment starts. And I think we'll see that ramp up through the end of this year, and in particular in 2021.
Next question. We've heard that the company's project margin in the United States and the Philippines ranges from 60 US cents to 80 cents per watt. How does that compare with the industry? Can you please confirm this, and if true, can you elaborate upon this?
Yeah, so there's a couple of different things I would say on that. So number one is that within the broader mid-scale solar market, commercial, community solar, and some other kind of areas within the mid-scale space, not all companies are created the same. One of the ways that UGE, that we really feel that we're setting ourselves apart, is by having the complete turnkey aspect to our business, right? So we're originating and developing these projects ourselves, we're engineering and building them, and then now more and more we're financing them to own and operate them. And when you put all of that together, you capture a lot more value or margin in those projects than you otherwise would. For anyone who's followed UGE for a while, we used to generate a lot of our revenue just from the middle piece, just the engineering and building piece. And when that's the case, you earn much lower margins. So I give that whole background because that 60 to 80 cents, I know in our investor presentation, we have an example that is from one of our New York projects, and that came out at 81 cents, if I'm remembering correctly. And so on that basis, that's sort of like the top of the range, and some projects might be a little bit more narrow as well. But that gives you a good sense. I think that in the public markets, there's not a lot of companies, even in the private markets, that are doing what we do. But in the public markets, the couple companies I can think of are much more just focused on the engineering and building of projects, and we certainly expect to earn much higher margins than that type of a business with our backlog and the revenue that we're now generating.
Next question. I understand that COVID-19 prevented the company from making construction progress starting in March through the end of May. Assuming we don't have a second wave in the fall, is the worst behind us?
Yeah, it's probably a little bit hard to predict precisely, but I think what we've seen, and of course, we're dual headquartered in New York and Toronto, and a lot of our work is in the greater New York region. And as everyone knows, this was the first area that was hit really hard in North America. And so, like the question said, things were really shut down during those early months. But even with expecting a second wave, what we've seen is, of course, there's a lot more protections in place and things like that. Wearing PPE and so on. And even in New York, when businesses were opening back up, construction was right at the beginning, if not the first, and the first wave of reopenings. Whereas a lot of businesses are still not open. You can't dine indoors and so on, right? So what we're hoping, and no one can be sure, but what we're hoping is that even as cases may flare up again or not, with proper PPE and protocols, the construction aspect of our business can continue during those times. But we'll all have to wait and see and manage our best through that as best we can. I think I'd be remiss not to mention that even though construction was slowed, it's been the highest sales growth that we've ever had, and so there's plenty of ways for us to be effective even when construction is slowed down.
Next question. What factors limit your ability to execute projects more rapidly, and how are you addressing them? How will the wind down of the solar ITC in the United States affect your business?
Yeah, so that sounds a bit like two questions, or at least I'll give two answers. And just to make sure I understood, Marcel, the first question was relating to sort of like what are the hurdles that are slowing us down from executing more rapidly? Is that right?
Yeah, how can you execute projects more rapidly?
Yeah, no, good. So I think the development of projects does take some time. The really good thing is that we have such a large backlog, and we are making really good progress on moving those projects through the stages. And I think that we'll see kind of waves of projects make it through the stages in the quarters to come here. And I think that we're getting much more efficient as we do that as well. A couple examples I'll give. Number one is, let's say we have a client commitment. Going from stage 3.3 to 4.0, there's really kind of two main steps there. One of them is just to sign the final form of the lease in many cases, and so if you're working with a client for the first time, that typically requires some back and forth and some lawyers involved just to make sure that everything is I's dotted, T's crossed. However, on virtually all of our clients are repeat clients that have multiple buildings or properties that we're working through, and so we already have quite a few of these repeat relationships where we in essence skip over that step, and so I think that's one of the areas. Another thing I'll mention is on the financing of projects. There's a lot of capital out there, a lot of financial partners. This is a non-dilutive project level capital, so it's not dilutive to shareholders, but just how we structure the financing for these projects. There's a lot of sources out there, but it often moves in a bit of a portfolio basis. So one example is that in the Philippines right now, we have a number of projects that are just at the stage where we're waiting for financing to close. And I really hope that when we're giving our Q3 webinar, that'll be one of the updates we give, because we're making really good progress on getting those projects into construction, which will happen right after financing close. On that, I'll say that with scale, we get a lot of efficiency in these types of things, and so we're definitely hoping that we can continue to get more efficient here in the coming quarters.
What's driving your clients to adopt solar solutions?
Yeah, so if I give a little bit of a history of commercial solar, the company itself is about 10 or 11 years old. And when the company started, it was really a cash deal basis for the most part. These would be clients who wanted to adopt solar because they wanted to make a green statement. And so those and solar was quite expensive at that point in time. And so that was a fairly slow process. The next step is, the cost of solar came down to the point where it was, let's say, at grid parity. But the regulations were such that you pretty much had to install solar on your rooftop and consume the energy yourself. So our clients were ones that wanted to save some amount of energy and use the energy on their own building. That said, most tenants don't own their buildings. We've all seen the proliferation of the REIT model and what have you. And so there's a little bit of there's a lack of a kind of connection between those two things. A tenant may want solar, but a building may not have a reason to. So what's really been driving the growth of our business in the last few years is what's called community solar, which allows us to bifurcate the host and the tenant. So in essence, what we're doing in most of our cases right now is we'll go to a big empty rooftop, let's say in Metro New York, and we'll just rent that rooftop from that client. So the client's receiving a rent for an otherwise unused rooftop, and of course they're happy to do that. And then we turn around and we monetize the energy produced through what's called community solar. And there's, it goes into a bit of detail in terms of how that works, but in essence, it's selling it into the grid, and the customers who are buying that energy are saving money on their energy bill without the need to actually have solar installed on their building or their residence. And so that's really opened up things in a very big way. So it was in the fall of 2017, if I'm not mistaken, that we announced our first New York community solar project, and that was actually the first community solar project in New York. And then earlier this year, we've announced a few now in Maine, and we're one of the first players in Maine. And there's a few other states that are at the same sort of cusp of really opening up. And so that's been a really big driver for us in terms of the growth of our business, and that's of course just on the back of the improving economics of solar.
Two-part question. How should we think about the ramp of recurring revenue stream? And how many months until you achieve an $8 million run rate?
Yeah, so in our backlog from Q2 here, the anticipated recurring revenue component from that backlog of projects comes out at about 8.6 million. the overall backlog, which kind of addresses another question I'd expect we'd get, is we aim to deploy that backlog within 24 months. So on that basis, we'd expect 2 years from now to have that type of recurring revenue, all else considered equal. And of course, I'll mention that we expect to, of course, win additional projects as well. But that's the anticipated timing there. I mentioned, I think it was in my prepared remarks, that since the close of Q2, we've turned on our first 2 projects. Those are in New Jersey, 2 self-finance projects, and by the end of the year, we expect to turn on others as well. So we'll start seeing that recurring revenue component tick up, especially as we go through 2021.
Okay, another question, actually 2 questions on the backlog again. Well done clarifying the backlog metrics. First question, is there any expectations on how much the backlog should grow quarter by quarter net of any completed projects? Let's start with that one.
Yeah, I think that right now with it being at 83 million, I'll say that when we started the year, we had a goal of exceeding 50 million, and of course we're already well beyond that. I think with that in mind, I think it's in our MD&A we mentioned that our pipeline, in addition to the backlog, is over 200 million. So there's a lot of opportunity out there, and we're excited to see it continue to grow. And I think the next milestone for us would be for the backlog to grow over 100 million, which we anticipate should happen this year. But the other really key aspect is seeing the backlog mature. So tracking the progress through the stages. And so that's the other thing that we're really just as focused on right now.
And the second part of that question, I heard you mention before that each kilowatt is worth 6 to 80 cents once developed. That puts your backlog at about $40 million Canadian at 60 cents, which is substantially higher than your present market value. Are there any private or public comps to illustrate this huge valuation disconnect?
Yeah, and I'll kind of reiterate those numbers because I think the math there is that there's about 52 megawatts of capacity on the backlog right now, and I think that the shared screen now has the backlog table up there, and the 60 to 80 cents that we talked about earlier, that's in US cents. So 60 to 80 cents. So we're 30 to 40 million USD, which at the low end would be about 40 million Canadian, just using 0.75 as the conversion rate, give or take. So that's the type of sum that we're talking about. In the public markets, at least in the more micro cap type of arena, we don't see another direct comparable there. You could look towards some of the larger companies, some of the and these might not be the best examples. And I promise to everyone on this call that offline we'll do some more work on this and work into our investor presentation and also next quarter's webinar as well. But there are asset owners that are public. A couple names that again might not be the best comp, but there's things like Brookfield has quite a large renewables arm. There's a company called Hannon Armstrong, which is a public asset owner. So there's examples like that. And then I think in more sort of the trade press and some of the areas more directly relevant to solar and renewable energy, you also can find quite a bit out there in terms of like the value of our assets. And I will say on that, we try to be conservative in what we do. In our investor presentation and in our MD&A, we talk about how we value our backlog, and so we use a discount rate in the US of 10%. I think you'd find that to be very conservative as well, based on what you'd read in the sort of trade press about what these assets often trade at. So I feel like I gave quite a bit of information there, but those are my initial thoughts on that. And again, a promise for us to do a bit more work on the comp side.
Another value-related question. How does the market value build own finance models compared to the traditional upfront revenue-based model?
Yeah, I think it's a good question. The few things I would mention, obviously, $1 of recurring revenue is worth a lot more than $1 of one-time revenue, and And so, I'll reference the comps discussion again there, and I'll hesitate myself from saying what that would be, but I would say it would be a multiple, especially when our recurring revenue, for the most part, has a baseline years of 25 without factoring in any options to extend or anything like that. So I think there's that aspect to it. But then, the other aspect I would say is that a growing balance sheet is going to be a key aspect of the valuation of the company as well. And that's a narrative that we'll see expand as more of our projects go from in development and in construction to in operation.
Question. Has the cost of insulation grown due to increased safety and health requirements brought upon by COVID? If so, can you quantify its impact upon margins?
Yeah, no, good question. And I would answer no, and not in any material way. We of course we have a PPE protocol internally, which is managed for each of our business units. We make sure that items like masks and gloves are worn and provided. But compared to the size of our projects and the size of our backlog, it's a immaterial sum. In terms of labor and what have you, we haven't seen any upward pressure on that. And in fact, we actually saw quite a bit of downward pressure on the cost of many of our main components, especially, like, for example, solar panels, which is the biggest cost component that we have. Just if we weren't the only ones that were frozen for March, April, and May. And so what you saw during that time is costs of those components decline quite considerably. Not 1 or 2%, but more in the range of 10%. So we're quite happy to see that, and it's of course on the back of a cost curve which has been declining more or less year over year since the beginning of solar.
Next question. How big did your New York City business become?
Yeah, so internally we've done our own analysis of that. Number one is that I'll just say, for someone who doesn't follow the market, like, New York State is very supportive. They have very lofty goals in terms of how much move towards renewable energy. Like a lot of places do, they also have retiring power plants coming up over this next decade, and pretty lofty goals. So we have a database of every building that we think is addressable for this market. We anticipate that over the next 10 years, the Metro New York market could be about 1.2 billion in project value. I think it's a bit of a moving target, but the amount that's been done here so far is probably 30 to 40 million in that range. And of that, we've probably contributed about a quarter to a third of that. So we're definitely excited about the long-term growth of this market here in New York. But other markets that we're in too. We think we have a good sustainable growth curve happening up in New England now, and of course over in the Philippines business as well.
Next question. Speaking of the Philippines business, what's happening over there?
Yeah, so what's happening? We've been in that market for about 5 years. It's been good for us. The economics of solar are very strong there. In essence, like that, as that market's maturing, we pioneered what's often called over there like a no cash out model, and so we pioneered a certain type of structure like that, and we financed our first 3 projects in that model in the Philippines over the last couple quarters, and I think that some, if not all, of those first 3 should be turned on kind of in the coming weeks. So hopefully within Q3 or into early Q4. And then the next slew of projects we have over there, I mentioned earlier on this call, but we're working on a close for some institutional financing on some projects over there as well. So yeah, I mean, it's a very good economics. We're certainly one of the bigger players over there. We have a really great team. And with some really good local connections that we've developed over those last 5 years. And yeah, so it's a smallish but meaningful minority of our overall revenue and backlog. But I think it provides a good model for us to think about future scale in some of the other markets as well. Albeit not in the immediate future. I think we're going to make sure that we get it right in our current markets first.
Next question. Could Canada become a focus region for UGE in light of Ms. Freeland's recent green energy comments?
Yeah, we certainly hope so. Yeah, I mean, and Canada's been there before. Ontario was really one of the first big mid-scale solar markets in the world. So we certainly hope so, and we're watching that very carefully. And and yeah, we're watching that, and we hope that it will. We haven't seen anything specific yet, but we're certainly watching for it.
Next question. What is the annual run rate for recurring revenue you need to achieve EBITDA cash flow break even?
Yeah, so
Assume
if
no new project construction revenue on that.
Yeah, right. So now in the backlog too, of course, we have the upfront aspect of it, and then we have the recurring aspect of it. Um, if we just look at the recurring aspect of it, it's in the range of maybe say 10 million. So this backlog is almost where we would need to be. And again, that doesn't factor in any of the upfront revenue or additional projects won.
Okay, next question. In the long term, mid to long term, what is UGE's endgame? Continued growth story, dividend payer, or buyout target?
Yeah, I think that the energy industry is changing so rapidly right now, and we really think that we have a great thing going on in the mid-scale solar space here. Finally putting together the turnkey platform of what we do, being able to develop, build, and finance, and that's I think I mentioned it before, but that's one of the areas that we really set ourselves apart versus the competition. And so on that basis, we're looking to continue to grow and build this base of recurring revenue. And as that occurs, I think that you open yourself up, and we're a little ways away from this yet, but you certainly open yourselves up to being a dividend play and so on at that point in time. So, we see ourselves as being the sort of modern renewable energy utility of the 21st century as we grow here, and that's very much what our focus is on. I think that there's always the possibility for acquisition or anything like that. Is not something that we're looking for, but I can't fully predict the future on that front. We're just focused on being a success ourselves.
Next question. How should we think about the regulatory environment in the United States, given that certain tax incentives for solar are in the process of winding down?
Yeah, so I guess one clarification that I'll say is there's an investment tax credit, it's called. It's a tax credit in the US. For the mid-scale space that we operate in, it's stepping down, but it's actually, as it currently stands, it never winds down completely. So it would go down to 10% a couple of years from now and stay at that, barring any change. And I say barring any change because there's very active lobbying right now to see that tax credit not just kind of renewed at its current levels, but actually re-upped to 30%, which is what the level that it used to be at. Um, and if that were to happen, that would be a real driver for our business, both for our existing projects and also the winning of additional projects as well. And I will say that of course there's an election coming up, and I think the likelihood of that happening increases if the Democrats win. But it's certainly not a foregone conclusion that it wouldn't happen under a Republican administration either. It was originally put in place under George Bush, and and there has been pretty active lobbying this year, and of course hasn't gone through yet. But I think that there's a possibility of that could occur in either administration. There's also, I'll just drop a seed here, that same lobbying has a component that says that instead of a tax credit, it being a cash grant from Treasury. This happened in the past. This happened after the Great Financial Crisis, and so we're very hopeful that that could happen. Without going into too much minutia on that, that would be an accelerator for how quickly we would be able to deploy projects and further boost their returns as well.
Next question. How much will recurring loan interest eat into recurring revenues?
So, yeah, one thing that we did in our financial statements this quarter is that we broke out the kind of the operating level debt and the project level debt in order to show that. the other thing I'll say is that like the cost of that debt is already worked into the cost of these projects. And so with that in mind, the types of margins that we've talked about, those are after debt costs.
Next question. What, if anything, is UGE exploring in the way of energy storage?
Yeah, another good question. We actually have a portfolio in New York City that has solar plus storage. It was we actually announced each quarter, aside from these from our financials, we separately, closer to the end of a quarter, we put out a release and an email kind of summarizing kind of quarterly milestones more from an operational perspective. And in our last update, which would have been early July, we mentioned that we had gotten permitting approved for the first set of these projects in New York, which is a big deal because permitting for lithium-ion batteries is still something that's tricky, and there's nowhere trickier than in New York City for that. So we are having some progress with that. There's some markets where it makes economic sense. There's still a lot where it doesn't, but we're seeing the shift in that direction. We're more or less agnostic to who we're working with on that side, but it's certainly something that we're quite interested in, and will take part in to the degree they can further improve the value of our projects. So I think I don't know that we'll announce any solar plus storage projects by the end of the year. I think it's a possibility, but I would say that if you look to 2021, I would expect that we'll start to see that more frequently for our project wins.
Next question. Any consideration to green bonds as a mean for financing projects?
Yeah, no, good question. We have done that once before. So in that sense, we have a precedent for tapping that type of for that type of product. We definitely are open to it. I think in the kind of current interest rate environment and so on, I think anecdotally we feel that there's been an increase in demand for that. At the end of the day, I think that someone can reach out to us anytime if that's an area that they're interested in, and we'll do the same. I think we'll gauge that, and it's not something that we need to do to see our projects be successful, but it could be a way for us to further share the opportunity of our projects with investors and tap good sources of capital for those as well.
Next question. How is the demand environment looking for solar right now?
Sorry, Marcel, you said the demand environment, is that right?
That's correct.
Yeah, so at the end of the day, in today's world, that demand is primarily an economics question, and the better economics have made it so that it's very much in demand. One other thing I'll briefly mention is, well, two things briefly. One is that as the industry has become more well-known, more common, we're definitely seeing barriers knocked down, where people are more quick to say yes when they've seen their neighbors do it. And then the other thing I'll say is that I mentioned earlier that New York is a good growing market with good government support. And so one thing that we have seen is an increase in demand from city and other public entities that are looking to adopt this as well. And the reason that's significant is that typically, because it's a government entity, they can't just you can't pitch them really. It needs to be an RFP or what have you. And so the fact that they're rolling out on these types of opportunities really opens up an additional space in the market as well. So we're seeing that happen too.
Next question. I think you might have touched on this before, but someone might have missed the answer. What's the incentive for customers that would like to move forward with UGE?
Yeah, the incentive really comes down to getting another tenant on their roof. If it's a lease, them getting paid for their rooftop, and or saving money on their energy, and something that of course we all spend money on anyway. And so if we can save them money with no money up front, then that should be a no-brainer as well.
Next question. What is revenue weighted average term of your recurring revenue stream right now? And are all projects tied to 25-year PP-like contracts?
So in reverse order, so in the second half of it, in this backlog table, you see the average project duration, and you see many of them are exactly 25 years. That's because in New York, that's our standard, or actually in the US, that's our standard. Um, it's not necessarily a 25-year PPA. Some of them are, but some of the community solar mechanisms are a little bit more regulatory driven than that. And in those cases, I think it varies by market, but you may have a certain number of years of certainty, and after that, it resets and what have you. So those are things that we watch, of course, very closely. Now, I'm sorry, Marcel, could you repeat the first half of that question?
Yeah. What is the revenue weighted average term of your recurring revenue stream right now?
Gotcha. Revenue weighted. Okay. Yeah, I think that looking at this table, you can see the heavy weighting towards 25 years. So it would definitely be in that range. I don't have the specific number, but that's definitely where it would fall. And I'll mention too, we don't factor it into the backlog, but we do in most cases have options to extend these projects at the end of term as well.
Okay. What is your internal hurdle rate levered? At what rate does it make sense for you to issue green bonds?
Yeah, so well, in terms of our hurdle rates, we talk openly about valuing the present value here, discount rates of 10 and 11% for the U.S. and Philippines accordingly. Our unlevered hurdle rates after we've built the projects and earned a typical margin on building the projects is typically in the 10 to 12% range unlevered, and on a levered basis, typically 20% or higher. And I'm sorry again, Marcel. Second half of the question.
Yeah, what rate would it make sense for UGE to issue green bonds?
Yeah, well, what I'll say on that is that the green bonds, for it to make sense, I'll just say, we've talked openly about like our debt terms in the U.S. and the green bonds would typically be a replacement for that. But in the U.S. right now, our debt rates have now on new projects fallen below 6%, and I think there's opportunity for it to fall even further. So those are the types of areas that I think we'd see it make sense in. I'm just spitballing when I say this, but it's probably in the 5 to 6% range.
Okay, and I'd remind the people listening on the call, if you have a question, please submit it through the Q&A tab on the left-hand side of the web portal. Oh, we have one more here. How much cheaper is the electricity from solar versus the grid?
Yeah, the answer has, I guess, a few layers to it. And the reason I say that is because, for UGE, it makes sense to, of course, provide good value to the users of that energy. But we don't, while at the same time, just like if you were selling anything else, you want to sell it at the best price that you can, right? What we found is through the community solar model, which is again most of our growth in our backlog right now, that if you're using energy from the grid, and let's say you're spending, just to use 15 cents per kilowatt hour is how much you're paying for that. The typical discount to that number that we require to sign people up to use up all that energy ranges from about 0 to 10%. A lot of people are still willing to pay, the same amount that they would to the grid to get solar. Of course, there's a moral benefit to going that direction. But in order to sign people up quickly, you usually offer a little bit of a discount. So that's typically how we see the community solar model work. In the New Jersey market, which has been a pretty good PPA market to put solar on a rooftop and sell that energy directly to the building itself, you see numbers that are 30%, 40% cheaper than the grid in those markets, and you still earn the target returns that we're looking to earn on that. So it again varies. I know in our Philippines market, the economics there are really quite strong, and you see 30, 40, even higher percentage decreases off the cost of the grid there. So those are the types of ranges that you would see.
Okay, one more question here, and I think you touched on this again before. The question is, what would you say is your secret sauce to winning new business?
Secret sauce. I think it might not be completely obvious from the outside, but we're very, very hyper local in terms of our focus. We know, like New York, for example, New Jersey, Maine, the Philippines. We know these markets very, very well, and we'll of course look to expand that area of influence over time as well. So there's that aspect. But then the other thing is that once we get to that point, being the complete turnkey operator where we're having the initial conversation with a client and then telling them that we're going to be the ones that are here for you throughout the entire process is something that really stands apart versus most of the companies in our space. The alternative would be one company is developing it and then they're selling it and then the company who buys it is hiring someone else to build it and what have you. And so, that secret sauce of having it all together, which includes the local domain knowledge, which helps us develop effective projects and put the whole package together is all where it lies.
Okay, it looks like we have no further questions. This concludes today's question and answer session. I will now turn the call over to Nick and Paul for any closing comments.
No, thank you, Marcel, and thank you everyone who tuned in today. And of course, if you have any questions, don't hesitate to reach out to us at any time. We're just flipping to the end here. So, myself or Paul and also Software Capital, you have their link there as well. Reach out at any time and appreciate everyone's interest and look forward to speaking with you all again soon.
This concludes UGE International second quarter of 2020 conference call. Thank you and have a good day.